I recently reread the book Am I Being Too Subtle by Sam Zell, who's by any measure one of the most successful real estate investors and general business people we've seen throughout the past century. Zell is known as the forefather of the real estate investment trust or REIT structure that is still widely used today, and originally founded a company called Equity Group Investments back in 1968, which led to the creation of several massive real estate firms that are still in existence today, including Equity Residential, Equity Lifestyle Properties, and Equity Office, the latter of which was sold to Blackstone in 2007 for a whopping $39 billion, making this the largest leverage buyout on record up to that date. And even though Zell has expanded into other business ventures outside of real estate throughout his career, this guy clearly knows a thing or two about the industry, and a portfolio of this size is not built by accident. So to help you tap into a little bit of Sam Zell's wisdom and over 50 years of business success, in this video I wanted to share 3 of the biggest real estate investing core concepts that I took away after reading this book, and how these principles can be applied directly to today's real estate market. So Equity Group Investments was founded by Zell in 1968, and obviously things have changed a lot over the past 50 years. But even though history doesn't always repeat itself, the economic landscape we're seeing today with quickly rising interest rates and rising inflation actually looks very similar to what Zell experienced in the first 15 years of his own entrepreneurial career, with record high inflation at that time that peaked in 1980 and the 10-year US Treasury yield hitting 15% in 1981. And the first core concept that I took away from this book is directly related to this subject, and this is that in an inflationary environment that is also seeing rising interest rates, borrowers of long-term fixed rate debt tend to win out. In the book, Zell wrote that we believe the real money in real estate came from borrowing long-term fixed rate debt in an inflationary scenario that ultimately depreciated the value of the loan and increased the position of the borrower. And commercial real estate is often seen as an inflation hedge, and this is in large part due to the combination of leverage and increasing rents that are often tied directly to the changes in the consumer price index. Hotel rental rates reset daily, multifamily lease terms tend to be reset to market every 6 to 12 months, and scheduled rent increases within commercial leases for retail, office, and industrial properties are often indexed directly to CPI changes. And at the same time that rents are keeping up with inflation, on the debt side of the equation, a fixed rate loan means that loan payments won't increase throughout the loan term, which can often lead to significant increases in bottom line cash flows to borrowers over the long term. And to show you an example of this, let's say we're buying a $10 million property that produces $1 million a year in revenue with a 50% operating expense ratio, and let's also assume that the deal is acquired with a 10-year 65% LTV loan at 3.5% fixed rate interest amortizing over 30 years. Now, going into this deal, the property's cash flow after debt service would be just under $150,000 per year on a $3.5 million investment, which works out to a 4.3% cash-on-cash return, which is nothing to write home about. However, if inflation numbers during this time come in even slightly higher than normal, by the end of the loan term, the cash flow the property is spitting off starts to look very, very different for the borrower. If we assume just 4% annual inflation during this time on both operating revenues and operating expenses, by year 10 of the loan term, our annual NOI has jumped from $500,000 at acquisition to over $711,000. But this $711,000 figure doesn't tell the whole story, since our loan payment has stayed the same during this entire time, resulting in our annual cash flow after debt service more than doubling since acquisition, from just under $150,000 to over $361,000, which represents a 10.3% cash-on-cash return on that same initial investment. And with inflation numbers that averaged over 10.3% between 1975 and 1985, investors in this scenario would have seen their cash flow after debt service increase by over 470% during this time, and even after accounting for double-digit inflation, this still represents a 237% jump from their original cash flow amount. Now, obviously, we don't know exactly what inflation or interest rate hikes are going to look like going forward, but it's pretty safe to say that interest rates have been at record lows up until the beginning of 2022, and inflation has been on a tear over the past year, and borrowers who took advantage of these rates by locking in long-term fixed rate debt are set up to see some pretty big spikes in cash flows and returns if both interest rates and inflation continue to rise. Now, the second big thing that stood out to me in Zell's book was his emphasis on a property's replacement cost, or the purchase price of a property relative to the cost to build a similar property in a similar location, which he credited as being the most reliable measure of value for properties in his portfolio. Zell said that replacement cost mattered more to him than rents, vacancy rates, or economic growth because replacement cost directly dictated the pricing of future competition in the market. And again, with the cost of materials seeing huge spikes over the last few years and inflation having a direct impact on the cost of labor, this thought process is also very relevant today when investors are looking at a new acquisition or at a property within their existing portfolio. Replacement cost directly influences the economic principles of supply and demand, and where rents and values within a market are likely to move as a result. For example, if you're considering investing in a specific geographic market and you know that properties are trading at a significant discount to replacement costs in the market, this can often mean that investors are going to be more likely to want to buy an existing asset rather than going through the headache and risk associated with taking on a new construction project, which keeps the risk of oversupply in the market low and keeps demand from the capital markets high if you ultimately wanted to sell the deal. And if a developer did decide to build new product in the market, significantly higher construction costs are generally going to mean that the developer is going to have to charge significantly higher rents in order to make that deal pencil, which can often insulate older product from any major drops in occupancy or rents, since these types of properties have now become the more cost-effective, affordable options in the area. To put it really simply, if you could live in a property built in 2022 and pay less than you would to live in a property built in 1980, all else being equal, you would probably choose the newer, nicer building, and paying more to live in the older, outdated property just wouldn't make sense. And when this plays out on a larger scale, this directly affects property values across an entire commercial real estate market. Now, the last major point that stood out to me in this book wasn't related to acquisitions, but instead, this was related to Zell's philosophy around decision-making on assets within your existing portfolio, which can be summed up really well by Zell's quote in the book that said, "I have always believed that every day you choose to hold an asset, you are also choosing to buy it." Zell talked about this in the context of the $39 billion sale of equity office to Blackstone, and when he couldn't personally justify buying the portfolio himself at the price that Blackstone was willing to pay, he knew that it was time to move forward with the deal. Timing the market is an extremely difficult thing to do, but Zell has never been shy about getting out of the market when he feels like things might be overheated, and he clearly hasn't let himself get overly concerned about leaving money on the table if he's wrong and prices continue to rise. And with valuations in proportion to operating incomes at sky-high levels in commercial real estate right now, I think there's definitely something to be said about taking a hard look at your own portfolio and deciding whether or not you'd pay the price a buyer would pay in the market right now for each property that you own. And if that ends up not being the case, this could be a sign that you're not the only one feeling this way, and if market conditions shift quickly as a result of things like continued rises in interest rates or economic slowdowns that impact pricing, there might be a better, more efficient use of your capital out there, and it might be worth considering taking your chips off the table. Now, it goes without saying that regardless of how successful one person has been, no one knows for sure what will happen in the future, but I wanted to share the principles in this book that I found most applicable in today's real estate market, and I hope these thoughts can help you gain some insight from someone who has built a massive real estate portfolio over multiple real estate cycles. And if you're looking to take a deeper dive into improving your own investment decision-making process and want to learn more about how to analyze and value commercial real estate deals, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models from multifamily, industrial, office, retail, and mixed-use deals, and you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on investment principles and advice from other legends in the industry, make sure to hit the like button to let me know, and let me know in the comments any similar real estate books, business books, or autobiographies that you've read recently that you would recommend. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.